just a quick refresher. What is a vertical spread? If we've got a stock trading at 100, okay, we could come in, we could sell the 90 puts, right? So here's the stock, 90 puts, that's a ways out of the money. Then we come in, we buy, that makes it a spread. Okay. So if we're selling this 90 put for, and I just threw some examples in here, 50 cents, and then we're buying this 85 put for 20, do we have more money coming in or more money going out? So we're buying the 85 put for 20, selling the 90 for 50. Anyone chime in the chat? Was Heather quick on the type there?
Yes, more coming in.
Yep, more coming in. So in this example, the difference there would be 30 cents. And that would be a credit to our account. More money coming in is a credit. So sometimes these get called credit spreads, right? Vertical credit spreads is kind of the technical term because we're using different strike prices, but they would be the same expiration. So we might use like the, you know, if this were a sleepover bandit trade, we'd be using the 7/7 expiration, right? Tomorrow's expiration date on both of these. Okay. So there is a margin requirement here, right? Because what this means when we sell that 90 put, we might have to buy stock at 90. And then when we buy that 85 put, that gives us the right to sell it, to put it to someone else at 85. So the broker is going to look at this and say, hey, you got $5 per share of exposure, right? Each option contract represents 100 shares. So you would have a $500 margin requirement here. So what that means is if you threw on this trade looking to make $30, we would have 500 of our buying power tied up to make that trade happen. All right. So we didn't have to buy anything, right? There's no debit to our account. We didn't have to purchase stock. We didn't have to we purchased this option here, but we're selling this one, bringing in even more premium. So the only cost for us to get this trade going is the broker is going to freeze some buying power, which is pretty much the same thing as buying something for $500, right? So that's the way my brain thinks about it. Whether I'm buying something and putting down $500 or I'm having $500 held in my account to get this trade going, I look at it as my investment is $500, right? Because whether I'm actually buying it for 500 or the broker's holding 500 to make that trade possible, it's kind of the same thing. Okay, so let's talk some ROI. If I stand to make 30 bucks and I've got to put down 500, okay, that's not quite 10%. Who's quick on the calculator there in the chat? What do we got here for our percent return on investment here?
6%. Everybody's coming in.
Say that again.
6%.
Okay, 6%. All right. So I've seen all over town, you know, the Apple made news. They started their high interest savings account, you know, 4% for the year, right? And that was for the year. So 6%, and if we're dealing with options that expire in a day and a half, that gets me excited, right? If I can make 6% in a day. So that's usually what we're talking about. Short term, building these credit spreads, kind of sleepover bandit style. All right, so what's different between this and the sleepover bandit? Well, if we're trading a sleepover bandit, just say on a stock like Apple, they've got the Friday expiring options. So we typically would come in on a Thursday. We have that one night sleepover. The trade's ending on Friday. Okay, we're building a similar type credit spread. And that sleepover had to take place Thursday into Friday. Okay, well, there's a few issues with that. The first Friday of every single month, a pretty important economic data point gets released, right? In fact, we've kind of seen some headlines in the news about that today. Does anyone know what that is? What gets announced, released the first Friday of every month?
Heather comes in with the jobs report.
Yep, jobs report. So that can cause volatility. That can cause swings in the market. So when we're talking sleepover bandit, we almost always avoid that first Friday of every month. So all of a sudden, the 4 weeks of the month, one kind of gets shaved down because of that jobs report. So we're all of a sudden, if we're doing our sleepover bandit, we're kind of left with only 3 weeks out of the month where we can come in and do that from Thursday into Friday. All right, so what I'm going to show you opens up the opportunity to do kind of a sleepover bandit style trade every single day. All right, the chance to make 2, 3, 4, 5, 6, 10%, depending on how you want to trade this, almost every single day. And you're never going to put your whole account into this, but you know, say you're trading with a $50,000 account. Maybe you want to peel off $5,000 and try to do this 2 or 3 times a week. Okay, and all of a sudden, maybe you're making another $500, $600, $700 a week. All of a sudden, you're staring at another 2 or 3 grand a month, which starts to really grow, doesn't it, on that $50,000 account? So, all right, are we good on vertical credit spreads? Any questions before I clear this off? So we've got the money coming in, we've got the money going out. Overall, it's a credit. We're getting paid. And as long as our stock that's trading at 100 stays above 90, we hit our max profit. So whether it finishes at 105, 101, 100, 98, 93, 91, we will hit that max profit. All right, any questions on the chat, Lee, before I clear this off?
How about doing the call spread at the same time? So that's the
Yes.
iron condor. I think you're going to that next.
Yep. So that's a big part of this. So in fact, I don't think I put that on my last slide, but I meant to. So this is just the put side, right? The put side, when you're selling a put, is bullish. Okay. And then what we can do is we can build at the same time. Let me just do it in this little window right here. We could build the bear call side. Okay, so let me write this in, the bear call side. So that would be selling maybe the 110 call, buying the 115 call. Okay, so again, stock's trading at 100, right? And maybe we bring in something similar. We'll just use the same numbers to keep it similar. Usually there's a slight difference, but not by a ton. So if we're selling the 110 call, buying the 115 call, we still have a credit. And then now here's kind of the trick, not really trick, but this is the fun question. If we have a $500 margin requirement down here, and we came on and we built this trade here that's got a $5 spread, what would the margin requirement be if we added this bear call along with that bull put spread? What's our margin requirement there? Did Heather get it? I'm showing it on the camera.
500.
It would be if it was all by itself, right? If we just traded this spread by itself, there would be a $500 margin requirement. But if we're doing both together, it's 0. Because how would this trade lose money? If we were above 110. How does the put side lose money? If we're below 90. So if we're trading the same expiration across all of these on the bear call credit spread and the bull put credit spread, there's no possible way the stock could finish below 90 and above 110 at the same time. So the broker only holds one margin requirement because there's no way you lose on both. It's impossible. It's impossible. The broker knows that. So if you were just trading the call side, which we'll talk about, there would be a $500 margin requirement. If you're just trading the put side, there would be a $500 margin requirement. If you're trading both, there's still only a $500 margin requirement. So what does that do to our ROI? If we have a 30-cent credit here, a 30-cent credit here, we're trading both, it's still only is a $500 margin requirement. We just doubled our income, doubled our return on investment. All right, so why don't we just do that all the time? Well, now it has to stay under a certain level as well as staying above. We just put a ceiling on it. But there's times where I'm going to, on purpose, look to do that. Even if I enter into those at different times, and maybe this is only a 10-cent credit, if I started the put side first and then I add this, why would that still get me excited? Because it's kind of like it's free income, right? It's not going to cost me any more buying power to throw on the other side of this. So the technical name for this, if we're trading both, we're doing the bear call and the bull put. Sorry, this screen is getting messy, but hopefully we're following this. That's an iron condor when we're trading both of those. That's the technical name for it. So if you see that in your brokerage account or you see it on some option trading videos or something, an iron condor is a put credit spread and a call credit spread together, same expirations across all 4 legs. Okay, but you can double up your income. All right, we got to move here. All right, hopefully that makes sense. Go back and hit that last 10 minutes or so of this recording if you're newer to credit spreads. So